All aboard! On today's video, I'm going to be talking about railroad stocks. Now, this is a relatively safe industry to invest in, and of course, with the recent news of a possible union strike, it brought it to my attention and I thought I wanted to cover, and I found some unique, interesting things about this industry, and it is helping me to decide if I want to invest in it or not. So I'm going to share everything railroad stocks, and of course, before we get started, as promised with every single video, I'm going to share my portfolio performance. So we'll see here that my portfolio has improved massively. I was about 4.2% in the red. Now I'm only about 1.14%. So that's only $550 of unrealized losses. This is awesome. I'm getting close to the green. Of course, we saw the Fed come out signaling they might not raise rates as high, but then we saw strong job numbers. So it's a mixture. But regardless, this is my portfolio. If you appreciate somebody that shares a real portfolio with actual money being invested in these companies that are my holdings, be sure to subscribe. I'm very transparent and think that's going to be something very, very beneficial for you as the viewer. So let's get right into these railroad stocks. Now, as long as physical goods need to be transported across North America, railroad stocks are one of the most important things to this economy, and it's the lifeline. It is the lifeline of this economy, and it can transport big, bulky items like semis could never do. So I think it's not a very disruptive industry. It's not likely to be disruptive, shall I say, and one that could provide a long-term investing opportunity for that reason. In fact, this industry is so important that the US government intervened to avoid a rail worker strike that could have cost the US $2 billion per day. That is massive. And it's unique in that the Democrats are usually heavily supportive of unions, but in this case, they went against them because it was just deemed too important to this economy. And if that strike happened, it would be disastrous, even more so than the pandemic. And so workers, what they want is paid sick leave. They also want better pay and better working conditions. And railroads have slashed labor in recent years and other costs to bolster profits. And what this has done is just left a very bad situation for workers. And they don't want to add that paid time because that means they would have to hire more staff, which would be more expenses for these companies. Now, I have a unique position because I have a friend, a very close friend that works in the railroad industry. And this was his dream since he was a kid. And he worked hard, got in the industry, and as of right now, he's doing everything he can to get out. He said it's horrible working conditions. They're so short-staffed that it's ridiculous. And so I really do feel for him and for all those that are working. So this definitely is not the industry to work in at this moment, but this is an investing channel. So is this a good industry to invest in? So I want to start by looking at the 5 largest railroad companies. We will see here that they are BNSF, Union Pacific, Canadian National, CSX, and Norfolk Southern. And their colors represent on the map where their railroads run. And of course, I want to look at the top 2 companies. We're going to have to take out BNSF though, because Berkshire Hathaway does own that company. So you cannot invest in it on the stock market. So we're going to talk about Union Pacific, which has a ticker symbol of UNP, and Canadian National, which has a ticker symbol of CNI. Now, before we get to really comparing these, let me discuss the railroad industry with a few more points. Railroad stocks are focusing on lowering those expenses and increasing that revenue. And I think this point I'm about to make is one of the reasons why we see these strikes wanting to happen. So one change that is being implemented is what's called precision scheduled railroading. And this is running trains between 2 points on a network on a fixed schedule versus the old hub and spoke model, where rail cars enter a hub on one train and then can be dispatched to their final destination pulled by another train. So this new model maximizes carload revenue and increases train length, which is going to increase the profits, lower the expenses of these companies. So under PSR, less railway equipment is needed, and they could shut down hubs that are no longer needed as well. So what this is doing is just improving the profitability of these companies. And now CNI, or Canadian National, already has adopted this model and has used it for a while, and it's proved to be very beneficial. Union Pacific just recently adopted it. And so I think that's why we're seeing these strikes, is because a lot of it has to do with cutting expenses, which would be the staff. So with this PSR model, I was looking into it, and it really does prove to improve the profitability of companies. This says that all the evidence suggests that PSR, developed and implemented by legendary railway CEO Hunter Harrison, helps improve railroad profitability and asset utilization. Indeed, Harrison generated significant improvements in the operating ratios of Canadian National Railway, which has been using it for a while, and it's one of the stocks we're looking at today. Now, the OR, the operating ratio, is commonly used metric in the railroad industry and represents expenses divided by revenue. So the lower percentage, the better, because that means there's less expenses. So we'll see here, when he was the CEO with these three companies, in blue was before he started, in red was at the end of his tenure. And you'll see that operating ratio went down with every single company every single time, which proves this PSR method really does work. So with Union Pacific recently adopting it, I think it'll prove to be very good for their profitability, which is something to consider. Now with railroad companies, revenue does fluctuate in parallel with the economy. So of course, when there's less demand, there's going to be less need for transportation, which might be a good opportunity now if you're bullish on these stocks to maybe buy in. These are bond-like stocks, so it's almost like they provide guaranteed revenue and appreciation in the stock price. They have wide moats. They're unlikely to be disrupted. The companies that are there now are most likely going to be there for the rest of our lives, and there should be no newcomers because it's so expensive to create a new company. These companies have very stable market positioning, and they also provide reliable dividend payouts, and they have a great history of doing so. So let's look at CNI's stock chart over the last 5 years. This is the first one we're going to look at, which is Canadian National, and we'll see here that they have gone up almost 60% over the last 5 years, and just since October, a few months ago, they've gone up 20%. So of course, we always look back and wish we could have invested at those lows, but you never know what opportunities might be presented in the future. Now, if we look at Union Pacific's 5-year stock chart, we will see here that they've done a little better. They're up 66.32%, and since October, they're up 15%. So these both have provided great returns for investors, providing more than 10% per year, and that is just fantastic. So performance has been good. But what about the metrics? Let's get into my favorite part, which is comparing their metrics. We will see here, UNP is the first column, which is Union Pacific, and CNI is the second column, which is Canadian National. So PE ratio wise, Union Pacific's trailing 12 months ratio is lower than their 5-year average, where CNI flips that, where they're currently more expensive than their 5-year average. So that shows me that Union Pacific, related to their PE ratio, is the better value right now. That's something to consider. Now, their earnings per share trailing 12 months versus the prior trailing 12 months, UNP kills it here at 20% growth versus CNI's 6.33. That's a massive difference. And they also lead in the 5-year EPS growth at 14.44% versus 8.09%. Now, revenue is relatively similar between these two companies. Trailing 12 months, Union Pacific is higher at 15.16%, but over the last 5 years, Canadian National is higher at 4.9%. But it's not that massive difference like it was with the EPS in that trailing 12 months number. Now, operating cash flows. This is one of the most important measurements, in my opinion. We'll see here that Union Pacific has grown 8.72%, where Canadian National has gone down 12.27%. So that gets a red highlight for me. Anything in green is a positive highlight. Anything for red is something I want to point out as a negative. Now, over the last 5 years, they're relatively similar in the 6.7% growth, but I don't like that their cash flows over the trailing 12 months have been going down. Of course, that could be used for investments, and it's something that you want to look into further if this is a company you want to invest in. Now, their dividends. They both have low dividend payout ratios, I think, compared to what people usually typically like, above a 3%, but Union Pacific's is more attractive at 2.42% versus CNI's 1.71%. Now, the 1-year dividend growth has been phenomenal with these two companies at around 20%, so that is something that is something to be excited about. Their payout ratios are healthy, below 50%. Union Pacific's at 46 and CNI is at 42. Gross margins for both these companies are excellent, above 50%. That is great to see. But when it comes to return on equity, Union Pacific outshines at 56% versus CNI's 28.65%. So definitely a big plus for Union Pacific. The other important measurement I like to look at is debt. And I like to look at the debt to assets ratio. And we'll see Union Pacific is too high for my liking at 52.06% compared to Canadian National, which is at 28.88%. They're going to be better off in any type of recession or economic downturn versus Union Pacific because they're a higher leveraged company. I don't like to see that. So that's a negative on Union Pacific. Their shares outstanding are both going down, so that's adding value to us investors. I like to see that. And then the market caps, you'll see Union Pacific is 132 billion versus CNI's 86.6 billion. So when looking at these metrics, what I take away is that Union Pacific is the more attractive investment, and I think long term will be better, but CNI definitely has its points, such as its low debt, and it still has strong gross margins and dividend growth. So both have their pros and cons, but I think Union Pacific with the metrics is stronger. So what is my conclusion on these two stocks? After talking about the industry, these two company leaders, I think these are both income-seeking plays. Look at what they're increasing over the last year at 20%, and with the relatively lower payout ratios below that 50%, they have room to keep growing these, and they're solid dividend players. They're very reliable, very safe companies as a whole. Like I said, they have a very low likelihood of being disrupted because they're basically guaranteed to stay where they're at because it's so expensive for a new company to come in. And I think they'll both provide long-term margin expansion from that PSR initiative. And I think more so Union Pacific because they just adopted that model where CNI has already used it for a while. So therefore, I'm a little bit more bullish on Union Pacific for that reason. And I think these will both provide good growth. There is a chance they can both outgrow the S&P 500. They can outperform it because I think these are such, obviously we've seen they're very needed, right? The government even stepped in a way that they usually don't. And this would cause great disruption to our economy, more so than the pandemic. So I think they're very safe buys. And I think because we're so dependent on them, they definitely will provide growth and could provide and outperform growth versus the S&P 500. So with that said, I think these two companies are a buy right now, more so Union Pacific because that PE ratio right now is below its 5-year average. So they're both on my watch list, but why not choose both? I had to put a corny joke in there, so that's all for right now. I think these are companies that I'd like to get into eventually. So I'd like to sell out of 3M, hopefully eventually, and put that money towards these companies that I think long-term will prove to be very strong investments. Of course, short-term, you never know. That with the economy having a hard time, it's going to affect these companies. But I think long-term, because these companies are so needed, they're so valuable to our economy, I just think these are going to be great stocks to hold. So I'm definitely going to keep a close eye on these. And I'd like to hear if you own these companies or agree with me that these are good investments. Or do you think there's some reasons why we should stay away? So I'd love to hear all your opinions. Thank you guys so much for joining me. And I hope you guys have a wonderful day. And we'll see you next time on Mark Arnold's Finance.